Welcome to this explainer. Right now, in 2026, we're witnessing a massive institutional tug of war over Banco Santander. We're going to unpack the massive institutional money flows shaping this global banking giant's future and track exactly where the heavyweights are placing their bets.
Okay, let's dive right into our roadmap for today. We're going to cover this institutional tug of war, look at the major buyers and sellers, check out the bullish catalysts, and then weigh the emerging risks, regulatory hurdles, and finally, the road ahead.
Section 1. The Institutional Tug of War. We are looking at a completely fascinating high-stakes divide in how the world's biggest investors view Santander's current prospects. The ownership data from the last 12 months paints a picture of intense, high-level debate.
Just think about this number for a second. Over $820 million. That is the sheer scale of the bullish conviction here. Over the last 12 months, institutions have poured that massive amount of capital into the stock, snapping up over 81 million shares. They clearly believe Santander's global scale is about to pay off in a big way.
But on the flip side, wow, over $602 million have headed straight for the exits during that exact same period. More than 160 institutional sellers have either slashed or completely closed their positions. When you've got this much smart money colliding, it means the market is fundamentally torn on where this bank is actually heading.
Section 2. Major buyers and sellers. Because it's not just retail traders making guesses here, Pinpointing exactly who is trading reveals some highly sophisticated funds taking really strong stances.
We're seeing heavyweights like Chevy Chase Trust Holdings aggressively buying in with over $14 million, right alongside Groupama and Lazard Asset Management, who are seriously beefing up their positions. But then, conversely, Fisher Asset Management is leading a massive sell-off, over $31 million in outflows from them alone. Arrow Street Capital and BNP Paribas are right there with them, dumping shares. So why does this matter? Well, these absolute giants are looking at the exact same data, but coming to completely different conclusions about Santander's profitability over the next few years.
Section 3. The bullish catalysts. So, the $800 million question is, what are those major buyers actually seeing that gives them so much confidence?
Well, they're looking straight at the newly released 2026 to 2028 strategic plan. And honestly, it is incredibly aggressive. Santander is targeting a bold 20 billion euros in profit by 2028, and they want to expand to over 210 million customers globally. They're also aiming for a return on tangible equity above 20%. But the real hook for the institutions? A rock-solid commitment to more than double the cash dividend per share compared to 2025, bumping that payout ratio to about 35% of group profit.
Executive Chair Anna Botín really sums up this growth strategy perfectly, highlighting how their sheer global scale builds a competitive moat that lets them confidently reward shareholders. The argument here is that their massive physical presence, combined with a solid decade of tech and AI investments, gives them an edge that regional banks just literally cannot replicate.
And for those yield-hungry funds buying in, the upcoming timeline is absolutely crucial. It maps out exactly when that increased cash hits their accounts. If you want in on the final 12.5 euro cent cash dividend against the 2025 results, which brings the year's total up to 24 cents, April 29th is your absolute last day to trade. The payout officially lands on May 5th. For funds managing billions of dollars, this kind of predictable, growing cash flow is exactly what they're paying for.
Section 4. Emerging Risks and Headwinds. Now, let's flip the script. What builds the bearish picture? What is making funds like Fisher Asset Management run for the hills?
The sellers are intensely focused on a distinct dual threat. First up, the European Central Bank. They're cutting rates, which inevitably compresses the net interest margin, the core way banks actually make their money. Second, and maybe more dangerous, is the Brazil risk. Brazil accounts for nearly 25% of the group's profit, but right now, they're facing a materially weakening currency and high inflation. That's forcing Brazil's central bank to tighten rates, which totally squeezes consumer credit. It is a highly volatile mix, and large funds are clearly spooked by it. On top of that, the bears are quick to point out that Santander's crucial domestic margins actually peaked back in late 2023. At home in Spain, competitors like CaixaBank and BBVA have poured money into digital capabilities. So that era of easy deposit gains, that's over. Acquiring new customers is getting way more expensive. And that directly threatens the very foundation of that ambitious 2028 profit target we talked about earlier.
Section 5. Regulatory and Capital Hurdles. The bearish thesis driving those major outflows isn't just about margins. It's also fueled by strict regulatory realities that put a tight straitjacket on bank capital.
Santander is officially designated by the Banco de España as a global systemically important institution, or GSII. Basically, because their footprint is so incredibly massive, regulators require them to hold an extra 1% capital buffer. That pushes their total capital requirement up to 14.11% for 2026. Sure, they're operating with a surplus right now, but these strict limits mean every single euro is heavily scrutinized. It puts a real ceiling on how much capital they can flexibly deploy for growth or buybacks if the economy happens to take a downturn.
Adding a bit more friction, the bank's digital unit, Openbank, was recently hit with a hefty $47 million fine by Spain's anti-money laundering watchdog. Now, Santander states these were historical procedural deficiencies regarding inactive accounts and that they've been fully addressed. Still, it is a stark reminder of the incredibly costly operational and compliance risks you face when running a massive, multinational digital banking platform.
Section 6. The road ahead. Bringing all of this together, the bullish dividend promises, the bearish margin compressions, regulatory fines, and the sheer volume of institutional cash violently changing hands. What does the road ahead actually look like for Santander?
Moving forward, all eyes are fixed on the September 2026 ECB meeting. This is a massive pivot point. It's going to determine whether that margin compression story really takes hold and wrecks earnings, or if the ECB pauses its cuts. We also desperately need to watch Santander's Q3 guidance to see if growth in their US and Mexico operations can successfully act as an offset. That would prove their geographic diversification is a true superpower rather than just a liability.
So, I'm going to leave you with this final thought to ponder as you watch this institutional tug of war play out. Trading at roughly 7 times forward earnings, has the easy money already been made during the recent rate cycle? Or is Santander's massive scale and aggressive 210 million customer target about to prove $600 million worth of institutional sellers totally wrong? It is a fascinating standoff, and the next few quarters are going to reveal exactly who was right. Thanks for joining me on this explainer.